The U.S. Federal Reserve has raised benchmark interest rates by 0.5 percentage points at its final meeting for the year. This takes key rates to a range of 4.25 to 4.5%. As expected, policymakers slow their pace of tightening as signs emerge that inflation is starting to cool. The move today also breaks a string of 4 straight 75 basis point hikes, the most aggressive policy moves in decades. But policymakers also maintain a hawkish bias. Fed Chair Jerome Powell says the fight to slow rapid inflation is not yet over and they have some ways to go.
Ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there.
In an effort to do more to restrain the economy, the Fed also signaled it would keep rates higher through next year. The median forecast for the policy rate by the end of next year is now 5.1%. That's up from the 4.6% peak that was projected back in September. They also expect inflation to remain elevated. Their preferred inflation gauge is expected to rise to 3.1% next year. As Mr. Powell stressed, inflation risks remain on the upside. Investors had been speculating that the Fed would soon pause its hikes as inflationary pressures ease, but Mr. Powell has pushed back against the idea.
I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way.
Wall Street's major indices hit session lows as Fed Chair Powell signaled more data was needed before the central bank would meaningfully change its view of inflation. The Dow, S&P 500 and the Nasdaq all closed in negative territory as investors brace for further hikes next year. Treasury yields initially rose, then fell after the Fed announcement. The US dollar index also slightly lower. Brett Ryan joins us now. He's senior economist at Deutsche Bank. He's joining us from New York City. So, Brett, just looking at what the Fed is signaling, higher than anticipated rates next year and no signs that it will cut rates until 2024. It also hardly acknowledged that inflation is easing, if at all. Did this more hawkish or less dovish tilt come as a surprise to you?
Well, it wasn't a surprise to us, and thank you for having me on the program today. We had expected the Fed to show a terminal dot of 5.1% for next year, as well as raising the 2024 and 2025 dots by 25 basis points apiece. So that wasn't a surprise to us, and it wasn't a surprise to us either that Fed Chair Powell came out with a strongly hawkish message. And that's to push back on the easing of financial conditions that we had seen over the previous few months in response to some of those improvements in the inflation prints. As Powell wanted to emphasize, financial conditions are important in their consideration, and he wanted to shift the narrative from some of the goods disinflation and deflation that we've seen recently as separate from what they see as what's the portion of inflation that's most important to them, which is core services inflation, excluding housing. And that depends on the labor market, and it depends on wage growth, which Powell described the labor market extremely tight to an unhealthy degree, repeating many of the comments that he said a few weeks ago. So, the bottom line for us was that the chair really wanted the market to price a more aggressive path for the Fed funds rate. The market going into the meeting was below what the Fed had in its median dot plot. And Powell wanted to emphasize that they're not considering pausing anytime soon. They're not considering from cutting next year, which is what the market is pricing in currently, especially as you get to the back half of the year in terms of the curve.
Okay, so the market is just adjusting to where the Fed wants things to be. But do you share the central bank's outlook on the economy, that we can still see a soft landing and just a slight bump in unemployment rate in the U.S.? I mean, the bond markets seem to be flashing those recession fears and how they're taking hold there.
Unfortunately, we don't share the Fed's view that there will be a soft landing, and we think that the tightening will result in mild to moderate recession over the back half of beginning in the back half of next year. So, timing of the recession is never easy to nail down, but we do see negative growth in Q3 and Q4 of next year, as well as Q1 of 2024. That will cause the labor market to start to loosen up, with the unemployment rate rising to about 5.5%, a little over 5.5% by the first quarter of 2024. So in our view, where inflation is coming from and how restrictive policy needs to be in order to guide it back toward target will basically necessitate causing a recession. Chair Powell admitted as much almost, a few weeks ago in his speech, where he said, there is a path to bringing inflation down without triggering recession, bringing supply and demand back in line in the labor market. Historically, it's unlikely, because the Fed has never been able to engineer a decline in job vacancies without seeing hiring roll over at the same time.
Oh, so we're going to see a narrower landing strip. But talk to us about the point of this whole tightening exercise to begin with. Which parts of the inflationary picture do you see reprieve coming, given that tightening monetary conditions as the year progresses in 2023?
Well, the most immediate effects, as Powell outlined today in his post-meeting press conference statement, has been a cooling of the housing market. So you've seen a sharp slowdown in housing transactions and existing home sales as mortgage rates have risen, more than 400 basis points alongside the Fed funds tightening. So that was the most immediate impact on the economy, Fed's cooling of the housing market. Prices are likely to continue to cool as well in the housing market going forward. What the Fed is really aiming at now is to prevent inflation expectations from becoming entrenched. So the longer that you have spot inflation elevated, the risk is that it becomes entrenched into consumers' expectations, and that gets filtered into the wage setting mechanisms, and that fuels problems such as you had in the late 1970s and early 1980s, in which the Fed then has to engineer larger increases and larger tightening and deeper recessions in order to guide inflation back to target. So at the moment, what Powell and company are trying to do is to slow labor demand. Right now, we don't have the labor market is extremely tight to a historical degree. That's fueling wage growth in excess of productivity, putting upward pressure on inflation, and that's what the Fed's aim is at the moment.
Slowing wage growth. Brett, thanks so much for sharing your insights with us. Really great to chat with you on the impact of the Fed policy, especially in the year ahead. Brett Ryan is senior economist at Deutsche Bank.